one of the things that I've always, wanted to keep as part of the legacy for this Katie School Symposium, CPCU Symposium, is the involvement of the academic community, either faculty, which we've had, faculty presenters over the years. But one thing we've always had on this is student presentations. And so we'll continue that tradition this year, and it's something that's our students will be presenting their parametric product. If you guys want to come on up now, we can get you started. Our student presenters are Aubrey Dale. She is a senior in actuarial science. Ben Leese is a junior in risk management insurance. And Sadir Ali is also a senior in actuarial science. And they're going to talk to you about their insurance product that they're proposing, and they've developed that as addressing a reinsurance gap. And it's interesting that originally, that Parametric was kind of set up for reinsurance as well. So I'll turn it over to you guys to do your presentation.
I am Ben Leese. I'm a junior risk management and insurance major here at ISU.
Hi, my name is Sadira. I'm a senior actuarial science major.
And I'm Aubrey. I'm also a senior actuarial science major.
We started this presentation as a 6-minute product pitch for a case competition at the University of Iowa, where we ended up placing third. Since then, it has evolved quite a bit into Weathering the Storm, a parametric solution for mutual resistance, where we will discuss a parametric reinsurance product meant to protect small mutual companies from skyrocketing cat losses caused by hailstorms.
So to kick things off, we'll go through a little bit of an agenda here. We're going to start off with the problem we found in the industry and some basic definitions around parametric and the issue that we're facing. And then we'll give you our solution, which is a parametric hail reinsurance product. From there, we'll move into how we selected our data source, what our data looks like, and how we decided to set the trigger for this parametric. Moving forward, we'll jump into the potential effects this product could have on the industry, and then any further considerations that we're considering for the future.
Yes, so as Aubrey mentioned, we're going to start off with defining what is the problem that we're trying to solve within the industry. And so the problem is kind of twofold, but as Ben mentioned, our product is designed for small mutual companies. So before we get into what exactly our product is, let's define what we mean when we say small mutual. So a small mutual we're defining as a smaller insurance company. They write business in maybe 1 to 2 to 3 states, and they have fairly limited exposure. And a lot of their exposure is concentrated in a single area, meaning that they're more likely to be affected by a single cat loss because cat losses can center around a single area. And the second part of the problem, or the first part of the problem, is we've been seeing an increase in catastrophes due to hail specifically. There's this graph on the right, which as you can see, as the years go on, the number of severe convective storm losses has increased as well as the severity. So you can see that the dollar amount in billions has really skyrocketed. And we know from speaking to meteorologists that 50 to 80% of those severe convective storm losses are attributed specifically to hail, which is why our product is centering around hail as a catastrophe, and that's what we're trying to cover. And the second part of the problem that we've been seeing is that reinsurance attachment points are on the up. Reinsurers are increasing retention rates for these small mutual insurers. So we spoke to one particular mutual who saw their retention increase from 3 million to 12 million, all the way to 22 million. That's a pretty substantial gap for these mutuals to cover. And that's why we've created our gap alleviation parametric to help bridge that gap. Just another look on that retention increase that I mentioned earlier. So the reason a lot of these mutuals saw their attachment points go up is around 2020, there was the hard market reset where reinsurers increased their retention rates for the primary insurers. And we have this graph on the right from Guy Carpenter, which the main thing to focus is that green line. As you can see from 2019 to 2020, there's that significant drop. And that's basically showing from the reinsurer side as they shift more of that risk back to the primary insurer with that attachment point increase. And next, I'll hand it off to Ben to talk about our product and how we structured our solution.
So Clive just gave us a great presentation about parametric insurance, but just to reiterate on that, parametric products, unlike traditional insurance products, are not indemnity-based and are instead based on a predefined parameter or trigger that when met will cause an almost immediate payout to the insured. And that brings us to our solution, the Gap Alleviation Parametric, or GAP. A parametric reinsurance product that would sit under the small mutual's traditional cat reinsurance coverage to cover a portion of that retention gap that Sally described. As you can see on the graph, that green bar is the coverage with GAP, and it's taking up a large portion of that increased retention. Mutuals would purchase this coverage on a county by county basis for counties that they have exposure in. And how would it be sold? These mutuals would be able to purchase an aggregate limit of up to half of their retention gap over the last 5 years. We're only covering half of that gap because reinsurers raised those retentions in the first place for a reason. So they don't want to go back and take on all that risk back on that they just ran away from. So we split the difference so that reinsurers are still willing to sell the product and the mutual companies are still able to benefit from it. Coverage for county would be based on percentage of total exposure in that county, and the product would be written on an annual basis with a maximum of 1 payout per county that the mutual has coverage in. Going back to that company that we discussed before, their retention went from 3 million to 22 million. So they have a total retention gap of 19 million and can buy an aggregate limit of up to $9.5 million in coverage of gap. Now, let's say that they have exposure in 5 counties in the state of Iowa, and they decide to purchase coverage for all 5 of them. The payout, or limit per county, is calculated as the total limit, in this case 9.5 million, multiplied by the percent of total exposure in each county. So if the company has 35% of their exposure in Jones County, the payout or limit for that county would be $3.325 million. Conversely, if they've only got 5% of their total exposure in O'Brien County, that payout is only going to be $475,000. So what's the cost? Our pricing formula is the probability of hail, probability of our trigger being met, which in our case is the probability of having 2 hailstorms with average hailstones of 1.25 inches in diameter or greater, multiplied by the limit for each county, which we calculated on the last slide, plus a profit loading for our company, as well as a possible concentration loading factor that Sally will talk about next. After that, Aubrey will go over how we set our trigger, but the reason that we set it there is to minimize basis risk, which is the difference between loss and payment. This is something that is implicit to parametric products, as there doesn't have to be a loss to have a payment. And we're really just trying to approximate indemnity for the insured here.
So as Ben mentioned, we are looking to add a concentration factor. So what is the concentration factor? So basically, this is an additional loading based on exposure distribution throughout counties for this particular mutual. For example, we would add a concentration loading if a mutual has over 50% of their total book of business in a single county. The reason we're adding this concentration factor is because we know hail cat losses can affect larger areas, so we want to include an additional premium charge for mutuals whose exposures are not very geographically diverse, meaning it's more likely that a larger portion of their book is affected from a single hail occurrence. If a mutual has all their eggs in one basket, so to speak, it's a greater risk for us to take on as compared to if their exposures were more spread out. That's why we have that additional premium charge. And now I'll hand it over to Aubrey to talk about how we set our trigger.
Yeah, so to talk a little bit about the trigger, we decided to go with a second hailstorm occurrence with average hailstones greater than or equal to 1.25 inches. We chose this for a couple reasons. As Ben mentioned, we wanted to negate basis risk as much as possible. So part of the reason we chose that second hailstorm is, one, a mutual should be able to afford their first loss or their first hail catastrophe. If not, they have a few issues other than just their reinsurance attachment points. And then also, we wanted to set it around 1.25 inches because After speaking to a meteorologist, we learned that hail damage tends to begin at the 1 to 1.25 inches mark. So we had to consider that on that first hailstorm, they might not have had that much damage, but having a second one in a year, they're more likely to have damage from those size hailstones. And then to give you a little bit of insight to what that hailstone might look like, because it's kind of hard to picture 1.25 inch diameter in your head, we have this little chart here that shows a 1.25 inch hailstone is about the size of a $50. So from there, I will continue to talk a little bit more about our data and trigger setting. So to jump right in, we have our data source. Our data source we chose was the Iowa Environmental Mesonet. This was recommended to us by a meteorologist, in which upon speaking to him, we also learned that in about 2010 or just before 2010, the Weather Service changed how they were reporting their weather data. So we decided to just use data from the past 15 years. So we have data from 2010 to 2025 in here. We also made sure that our data was cleaned of any non-trained spotters. So the data did have some that said public or maybe even some unknown. We decided to remove any of that and stick to just trained spotters or emergency personnel to make sure that our data was as accurate as possible on these storm reports. And as you can see, I have a little chart along the bottom that gives you a sneak peek into what some of the data looks like. There is a lot more in this data set, but these are some important ones to just kind of let you know what's going on. So going from left to right, you can see that we have the report time down to the minute, as well as the county, location, and state. All of our data for this project was in Iowa. Since we started this for a case competition in Iowa, we wanted to make this Iowa focused. However, this data set does have data for all 50 states, as well as US territories like Puerto Rico and Guam. And then, of course, we have the event type, which we limited to hail. Magnitude in inches, we have a 1.25, for example. Our source, which is our trained spotters and emergency personnel. And one thing that we thought was unique about this data set was it actually went down to the latitude and longitude that this hail was spotted at, which we thought was pretty cool to see. So this right here is a heat map of the average hail size by county in Iowa over the past 15 years. I created this using our data set in Python. So as you can see, kind of trending across the state, it kind of gets more severe. You get those bigger sizes as you get to the western side of the state, which is something I will touch on a little bit later too, as it's part of an interesting trend that we saw. But as you can see, most of these counties are all ranging in that 1 to 1.5 area. So this is just showing that these hail severities are happening. So again, in setting the trigger, this heat map is displaying more of how many storms were reported with that hail size of 1.25 inches or greater. As you can see around the bigger cities in Iowa, so we'll take a look at Polk and Jasper County, for instance. That is where Des Moines is located, which is the capital of Iowa. They have a lot more reports there. And there's also the unique little, what seems like it might be an outlier of Pottawatomie County. But actually, if you were to take a look at that state and see how many times the parametric trigger would have actually been met in the past 15 years, it still would have only been met, still would have only paid out up to 3 times. We really wanted to make sure that our parametric trigger was more towards the 1 in 7 likelihood event, because we saw that reinsurers were moving towards the 1 in 10, 1 in 15. So again, we kind of wanted to bridge that gap, give it a little bit more leeway in that instance. I also learned recently that Pottawatomie is on the other side of the border to Omaha, Nebraska. So we may be seeing more reports there because of that more metropolitan area that the rest of Iowa doesn't really have as much of. I also wanted to talk about the potential for this to expand. As you can see here, we have a map of the United States. And although our project was focused specifically on Iowa, this really could be expanded to the entire central US. This is a map from FM Global that shows how they deem hail severity classifications. So this dark pink color is their very severe category, which means there's a likelihood of hail being greater than 2 inches. So as you can see, the severity is there for all of these central United States, and this project could really expand through there. I also wanted to note that about a month ago, a little over a month ago now, when we had those string of hailstorms that came through Illinois. There was one in Kankakee that actually had a official reported hailstone of 6.14 inches in diameter, which is about the size of a mini Nerf football. And that definitely rang through a lot of damage, and we think this product could have been useful in a situation like that. If you don't know the size of a mini Nerf football, I can say that it's also approximately the size of your standard smartphone. So a pretty big hail size there. And Kankakee isn't even located in this very severe category. It's actually on the eastern side of Illinois, more towards Chicago. So it's something that is definitely prevalent that is happening right now. So now I will pass it over so we can get started to talk about a little bit of the effects this project could have on the industry.
So who would take on the risk for this product? We would license GAP to reinsurers who would then sell it as a product to the small mutual companies. Ideally, this would be a secondary reinsurer separate from where the small mutual gets their traditional CAT reinsurance. Using a secondary reinsurer would help keep the reinsurer and the mutual diversified. As I mentioned before, the reinsurers raise these retention rates in the first place for a reason. They don't want to take back on exactly what they just ran away from. Keeping it diversified makes it so that everyone can still benefit from the product in the market.
And so now talking a little bit more about the mutuals, what is their need for this? And the biggest one we found throughout our research was this product would help protect a mutual surplus. We know that large cat losses without enough reinsurance will deplete a company's surplus. And we also know that mutuals oftentimes can't get rate fast enough to cover that gap on their own. Since this product is focused on a mutual's homeowners books, we know that there can be political considerations on a mutual's ability to get rate changes based on the regulatory environment that they're writing in. So we find that this product would help fill that gap in cat coverage and protect their surplus from devastating cat losses. The second potential benefit we noticed is that this product could help protect a mutual's credit rating. We know that AM Best assigns mutuals and general insurers a credit rating based partially on the amount of reinsurance that they're able to purchase. So mutual's credit rating could decrease if they don't have enough reinsurance, and our product could offer an alternative form of reinsurance to protect that rating. And the mutual we spoke to earlier, they did face this similar issue of their AM Best rating decreasing because of their attachment point increases. And finally, our Parametric product could help a mutual maintain their market share. We've seen throughout much of the central United States that many mutuals have had to eliminate their homeowners books simply because they don't have enough cat coverage to sustain that. Our product could help alleviate some of this burden and help bridge that gap in coverage while ultimately allowing mutuals to offer their homeowners products to individual policyholders.
Yeah, so why does the market need this? We want to make a note that area-based parametrics are already out there in the market. They already exist. Companies like Demex, Descartes, and Arbol Insurance all offer several parametric solutions for natural disasters. What makes this unique is that these current parametrics in the market aren't focused specifically on protecting these small mutual companies like our project would be. And after speaking with multiple reinsurers and mutuals, we confirmed that this is a solution that's needed in the industry. We also wanted to talk a little bit about market cycle implications. The birth of this product was due to the hard market reset that happened in 2020, but we wanted to make a note that this still has soft market applications as we move into the soft market. So one of the ideas we had was this could be used for mutual expansion. So say one of your mutuals in Iowa wants to expand into Illinois, but they might not have an actuary on staff to do all this weather modeling, to do all the things that they need to really know exactly how they need to price this book. This could have the potential to allow these mutuals to keep that high retention with their reinsurers while still having the extra protection and comfort of that of the parametric being there in their case of need. I also wanted to talk about how this is not a replacement for traditional reinsurance in the slightest. It's really just meant to sit under and bridge that gap between where reinsurance was and where reinsurance is now. But it also comes with the benefits of being parametric. It's a cost-effective solution to a big problem. You're cutting those underwriting costs. You're getting close to immediate payouts, which helps these mutuals in getting their payouts to their customers. and it cuts down on claims and exposure analysis costs.
So an important thing to consider with any new product is regulation. Currently, the NAIC has very limited regulation published regarding parametric policies, let alone parametric reinsurance. Majority of the information that the NAIC has released relates to general information about parametric structures rather than regulatory guidelines. However, we can theorize what sort of an impact our product would have, and we suspect that it would offer a reinsurance credit similar to traditional reinsurance and ultimately increase a company's RBC ratio. And I'll get more into that on the next slide. So risk-based capital ratio indicates an insurer's ability to pay claims based on how much capital they have and how much risk they've taken on. RBC ratio is a regulatory measure, and the higher that ratio is, the better standing a company has. And so I've got the formula up here. Basically, RBC is total adjusted capital, how much money they have over that required capital that they are required to have based on their risks. And so that formula is also below, and you can see that there's these various R's which represent various risks a company faces, ranging from premium risk to credit risk. And we'll be focusing largely on RCAT, which is catastrophe risk. And so with traditional reinsurance, RCAT goes down through the purchase of that, and we suspect our product would function in a similar way, where RCAT would decrease by purchasing the gap alleviation parametric, meaning the required capital a company would have to keep would also decrease, ultimately increasing that RBC ratio. So as I just mentioned, we are still theorizing the potential impacts of our product, and as we continue our research, there are a number of further considerations that we're still looking into for this product. The first consideration is reserving. We're actuarial majors here, can't forget about reserving. So the one thing we did know about how reserving would work with parametric is it would be much more simpler compared to traditional indemnity-based products. With indemnity products, the final loss amounts aren't known till much later, but with parametric's predetermined payouts, the severity of each loss is already known. The only thing that really changes is that frequency piece, which we're estimating directly from our weather data. And with parametric payments made almost immediately, this decreases the processing time and reduces the need for extensive IBNR calculations. Additionally, with the payout limit set well in advance, there's a limit to what the parametric issuer is on the hook for, which overall simplifies that reserving process. And the next consideration we have is risk transfer through insurance-linked securities through the form of a cat bond. The reason we're looking into cat bonds is to potentially eliminate that need for that secondary reinsurer to sell the product. So this would basically mean that we, as gap alleviation parametric, package off this risk and sell it off to the investment market, where the investor invests at a high rate, and if that trigger is met, meaning we have that second occurrence of average hailstones greater than 1.25 inches, the mutual issuer receives that principal amount, and if that trigger is not met, the investor receives that principal plus that interest set well in advance. So we're doing this to eliminate the need for that secondary reinsurer, and that's beneficial because as we saw from the hard market reset, reinsurers aren't too keen on taking on all of this risk, so selling it to the investment market could be beneficial for all parties involved. Thank you for listening.
With that, we'd like to open the floor for any questions as well.
Let me just stop sharing so we can see it. Just
I
here.
did.
Let's go. Stop sharing here. There. So I'm going to ask a question while we're looking for any questions from the audience. I'm going to ask you a question that's not a technical question because I think you guys know, and I really like the last section you guys added, which was related to the potential for parametric catastrophe bond, a product that would, be some capital that could occur, in lieu of reinsurance capital. So that was interesting. What did you guys get out of this, and why, if you were a student, group, were saying, we're thinking about doing a project like this, but I don't know if it's worth our time. What would you guys say is kind of why would you do it? What was the value?
I think the biggest thing for me was just learning more about like a niche in the industry. I feel like as actuarial majors and even to some extent as RMI majors, we don't necessarily get to experience a lot of the industry itself in the way that we did. Like we spoke to so many people throughout our research with this project, and it was very valuable to make those connections like that.
I think,
Oh, yeah, you have something on.
so I think I can agree. I think the big emphasis for me was being able to speak to so many different industry professionals and so many different areas of expertise. We really got to learn through hands-on conversations and develop this product as it went. And it really felt like we were creating something unique.
So what's one of the questions here is what's the market share for small mutuals and coverages, and what's your next steps?
I'd say in terms of market share, I feel like it's pretty substantial. We spoke to a number of small mutuals that confirmed that this would be a product that they'd be interested in. Additionally, we met with a couple of reinsurance brokers as well that said that, yeah, no, they would be interested in selling this type of product because they have been on the other end of having to raise their attachment points and kind of seeing that their clients aren't necessarily getting the coverage that they need.
Well, I think that's it then, Thank you for your time. Great presentation. You guys have really developed this over the last few months since you did that initial 6-minute presentation. So good job. All right. Well, this is the end of my last session for the last symposium, and it's been a great ride. I do love that we have student presentations. I hope that after I leave, you guys will still continue to involve students, and you guys will have to be the ones to be ambassadors for why students should be involved in taking time away from their busy schedules to do a presentation like this. So